Welcome back. Today we're doing a head-to-head valuation video, AT&T versus Verizon. These are two stocks that seem like they're selling at a discount at first glance, just looking at PE ratios and stuff. But since they're in the same industry, what I wanted to do was compare their fundamentals, compare some of the intangibles, how their financial statements look, and pit them against each other and see if we can figure out who is the best investment right now, if there is one, right? Alright, so let's get started real quick. I'm just going to kind of walk you through the format here. I got up top is going to be all of AT&T's financial statements. This is every quarterly report going back to, I think, March 2012, so the last 10 years of quarterly reports for each company. And then above me is just a little bit of overview of the stock price and the market cap and everything. And then we got the metrics that we're going to judge them against versus each other, all right? And then I'll end the video with my fair value and then tell you what I think about each stock, okay? All right, so let's get started. First thing, revenue growth. Who's got better revenue growth over the last 10 years? And you can see for each one of these is going to be pretty abysmal. Look at this. AT&T first. Okay, so they went from $31 billion a quarter in revenue up to, let's say, $39 billion. So 31 to 39 on the calculator. 39 divided by 31. I raised that to the 1/10 because it happened over 10 years. And I get a growth rate of 2.3% per year. So the revenue only grew at like 2.3% a year. That's terrible. Let's see if Verizon's any better. It doesn't look like it. Verizon, it looks like, went from, 28 up to, let's say, 34. Oh, so 34 divided by 28. Raise that to the 1/10. And you can see they grew at 1.9%. All right, so they're both terrible growth rates. All right, if you're going to grow at 2% per year in revenue for 10 years, I would hate to be invested in that company. But anyway, AT&T gets the win for that category because they had a little bit higher growth rate, okay? All right, moving on. Let's look at their margins. Okay, so the first thing is going to be operating margin, and what we're looking for here is consistency, growing, and seeing which one's higher than the other one because these two, like I said, are in the same industry, right? So who's doing better after we subtract out cost of goods sold and our operating expenses, all right? So you can see AT&T, it looks like they're hovering around this 15% range, whereas Verizon is consistently above 20, so that's good on their part, to be higher than AT&T. And then let's see, we're going to look at another type of margin. We're going to do net margins. All right, so here about the same story. AT&T is a little bit lower than Verizon, but it seems like Verizon's losing a lot of its margin in between the operating and the net margin, whereas AT&T, that blow's not as big in between, but still, Verizon's got better margins. They're, in between 10 and 20% consistently, and it looks like AT&T's just now recently getting over that 10% net margin, so I'll give the nod to Verizon on this one. All right, next up, we're going to look at return on invested capital. So I like using return on invested capital, either that or return on assets, not as much return on equity. I think return on equity can kind of fool you if you're looking at a company with a lot of debt that you think that they have great return on equity because they have low equity. So I prefer to look at either return on invested capital or return on assets. And I like it because it's like a good way to combine the balance sheet and the income statement. I know I described this with return on assets. It's like how many assets do you own, how much assets do you own money-wise, and then how good are those assets at making you money. So you take your income divided by those assets. Return on invested capital is kind of the same number usually that you get to, but the way that you think about it is you say, how much capital do I have invested in the business, which is all your equity plus your interest-bearing liabilities, so debt plus equity, and then you take your income and divide it by that sum instead of assets. You usually get a pretty similar number, but in this case, we're just going to use return on invested capital. All right, so just looking at this, look at AT&T first. Their, invested capital has been, in some instances lower than 5%. Wow, that's terrible. Recently, like in the 5 to 6% range, not good at all. Verizon's not too much better, but at least they're hovering close to 10%, which is, okay. So for that reason, I'll give them the edge there as well. But like I said before, for some of the other categories, nothing super impressive in either camp. So next we're going to look at their debt load, and there's going to be two ways that we measure this. So first we're going to look at their debt to equity ratio. So this is all their liabilities divided by all their equity, and then we're going to see who's got, less debt compared to their total equity, which would mean who's got a smaller debt to equity ratio. All right, so then we're going to look at it that way, and then we're going to look at your interest payments divided by your operating income, and I'll explain that once we get to it, okay? So first off, debt to equity. All right, so it looks like AT&T's higher, but that's just the scaling here. You can see Verizon's actually, if you look down at the bottom here, in this like 3 to 4 range on debt to equity ratio, whereas AT&T's consistently around 2. So they do have less debt compared to their equity. Now what I want to do is look at their debt compared to how much money they're making, and I'll show you how we're going to do that. Okay, so what I've pulled up is each company's interest payments. So look here at Verizon, for example, it's all their interest payments divided by their operating income. Literally, this is what percentage of your operating income is having to go to interest payments. And y'all know I do not like this high. I think, if it gets to double digits, I'm a little uneasy. If it gets above 20, I really don't like that, because to me, that's just like another tax to running a business, right? If you have high interest, that's just money that you're throwing away because you're in debt. Who'd want that? The great businesses that we look at on this channel, some of them have the interest divided by operating income of like 1 to 2%. All right, so just keep that in mind. Anyway, Verizon, look, 10%. Like I said, that's in the textbook okay range. I prefer lower, but it is what it is. Now I'm gonna look up here at AT&T, and oof, look at this. This is wild. Like close to 30%. Most recent quarter, 31% of their operating income went to interest payments. So think about that. Their operating income, which is their income, and they already had a lower margin on operating income than Verizon, so they had that, and then they're taking a third of that away just to pay their debt collectors, okay, before they even get to, net income and earnings per share and stuff like that. All right, so don't like that at all. This nod is going to Verizon. I know AT&T had the lower debt to equity, but in my opinion, I think it's more important to have low debt compared to how much money you're making, because that's what's going to keep your debt collectors away, right? Is if you're continuing to be able to meet the interest payments. If your interest payment is 30% of the money that you're making, that's really scary, right? Because if you had a down year, you could wind up not being able to make interest payments. So that's why I value this more than the debt to equity ratio. But I do like to look at both of them, okay? All right, now we're going to go to our cash flow statement, and we're really just going to look at free cash flow. All right, so earning money on paper via income and stuff is nice, but what we're really after is good cash generative businesses, right? Businesses that are generating a lot of cash, a lot of free cash flow. So this is a metric you always want to look at whenever valuing a company. Okay, so right away, look at this discrepancy. I mean, AT&T's been climbing, that's good, and they had a recent down quarter, that this Q1 2022, but that, that could just be by design or whatever. But Verizon, I mean, this is terrible. I mean, they're decreasing. They're having close to negative cash flow quarters. That's kind of spooky, I think that this one definitely goes to AT&T. I mean, look at this free cash flow that they were generating before. I mean, you're talking close to $8 billion a quarter in free cash flow for a while, versus a market cap of 146. So 8 billion a quarter times 4, so 8 times 4 in the calculator is 32. So you're talking about a free cash flow multiplier on the high end of like 5 on AT&T. So that's really good. Okay, so they get the nod there. All right, so lastly, we're going to look at valuation. And to save you time, I've done deep dives on both these companies, and so I kind of have an idea of what, textbook fair value is for each one, so I'll just put it in here. For AT&T, just based on textbook valuation metrics, and I'd go over those in my other videos, I think it's like $36 a share. For Verizon, it's more like $56, okay? And you can watch the deep dive videos I do to get a better understanding of how I come up with that estimated fair value. But y'all know, if you've watched my channel before, I think that that's probably the least important step to like really pinpoint that and get it down to like 3-4 decimal points. I think getting a feel for the whole company is better than just making sure that it's undervalued. All right, but real quick, who gets the nod there? I mean, it's going to be obvious. It's AT&T, right? Like 36 divided by 20. They have 80% upside to their current share price, and Verizon's more like, 56 divided by 49? They're like 15% upside. Okay, so AT&T looks like, textbook definition, it's more undervalued than Verizon right now, okay? All right, so I got a 3-3 tie on this. What's my opinion? I would say neither, to be honest. I think they both have stuff that I hate in companies, and I don't own either, and I'm not planning to own either. But if I had to pick one, if I had to pick one right now, I guess I would say AT&T, maybe because of the free cash flow. That means a lot. Plus, I think they're a little bit more at a discount. But that being said, Verizon, I think, is more of a lower risk investment. Like, they don't have any risk of like going into bankruptcy and stuff. Or I shouldn't say that. They have less risk than AT&T, I think, because they have much better margins and they just have a better debt load, I think, compared to how much money they're making. But anyway, that's my opinion. I hope you enjoyed the video. If you want to see more like these, give me some pairings below and I'll try to work them in. Or check out more on my channel for detailed dives on individual companies. Thanks for watching.